All right, can you see the screen?
Yes.
Okay, let me make it bigger. Okay, IFRS 15. Okay, this standard is basically on the accounting treatment of revenue, how to recognize revenue in our financial statements. So first of all, we need to know what revenue is. Okay, so when we say revenue, revenue is basically the income generated from the ordinary course of business. Okay, it refers to the income generated from the ordinary course of business of an enterprise or of an entity. So revenue can be generated when an entity sells goods or services, so that income that is earned from the sale of goods or services is called revenue. Right? And revenue is an important figure, or is an important uh, let me say line item in in the accounting or in our profit or loss account, because everything hangs on revenue, whether the company will make profit at the end or will make loss at the end. It's all dependent on how much revenue the company is generating. All right, so it is an important figure, and therefore we must make sure that we record or we report the accurate figure, because if revenue is misstated, it's going to affect the entire, it's going to have a pervasive impact on the account. All right, so and when it comes to audit, even in audits, revenue is an area that is usually handled by experienced auditors, because of its um, complexity and its impact on the whole account. All right, so IFRS 15 is there to ensure that we get revenue right. The revenue figure is accurate, is correct, it makes sense. It reflects what the company has sold, that's or what the company has actually earned, you know. So the bottom line of the standard is that you recognize revenue when you have worked for it. So like when we when I can let me compare it to earning salary at the end of the month. So you are paid salary after working for that month, right? So if you don't work for the month, you are not going to earn your salary. So the standard is saying that revenue is earned. To earn something means to work for, like to actually put in efforts to work for it. All right. So you cannot recognize revenue if you have not worked for it, or put it in another way, if you have not earned the revenue. Okay, which means that if a customer makes a deposit, maybe a part payment of a product or a service, and you have not delivered yet, it means you have not earned the revenue. Okay, you have not earned. It's just a deposit the customer has made. All right. So you only earn when you deliver the product or you render the service. All right. So the head and tail of this standard is that we should make sure revenue is recognized when we have actually worked for it. Okay. All right. So what is revenue? Revenue refers to income earned from the sale of an entity's product or services. So that's revenue. And revenue is an item that can be manipulated by senior managers or salespeople, especially if the revenue is tied to compensation, maybe bonus. If we are able to achieve certain amounts of sales, we are going to get some bonus and so on and so forth. In that case, there's this incentive to manipulate the figures. So aggressive revenue recognition, and I mean that will also lead to misstatement of the account. Okay, so the standard is there to ensure that we account for revenue correctly. We don't manipulate revenue figures to achieve a desired outcome. Okay, and the standard also tries to explain what revenue is, okay, and how it is accounted for. Okay, and it ensures that if companies or entities are using the same standard in accounting for their revenue, it promotes what comparability. Okay, we can compare two accounts of two different entities. But if the entities are using different revenue model or revenue recognition policies, it's going to make it difficult to compare results of two different companies or entities. All right. Okay, let's continue. Okay. So IFRS 15, okay. IFRS 15 talks about the nature of revenue, the amount of revenue, the timing of revenue, and also uncertainty of revenue. So when we are going to take them one by one. When we say nature, what are we referring to? So when we say nature of revenue, we have different types of revenue. We have fees, we have royalties, we have we have commission. There are different types of revenue. Okay, so this refers to the nature of revenue. So revenue can come in different forms. Okay, in a form of fees, in a form of um, fees, royalties, licensing, sales revenue, rent income, commission. So it can come in different form. And then when we talk about the amount, okay, the amount we are referring to how much we are to recognize as revenue. Okay, when we talk about the amount here, okay, how much should we recognize as revenue? Okay, then let's look at the timing. The timing refers to when revenue should be recognized. Okay, the timing is looking at when should we recognize revenue. Should we recognize revenue when payment is made, like the customer makes payments, or should we recognize revenue when um, the goods are delivered or the services are rendered? Okay, so the timing looks at when we should recognize revenue. Then we have uncertainty of revenue, the uncertainty. Okay, so the uncertainty talks about um, the the factors that can affect the amount of revenue to be recognized. Okay, the factors that can affect the amount of revenue to be recognized. For instance, if we have a variable consideration, When we say variable consideration, we are referring to the revenue or the amount we expect to earn, which is not fixed. I mean, it depends on certain external factors. Okay, so for instance, when we look at performance bonus, performance bonus, we can only earn the performance bonus after achieving a certain target. Okay, so it's a variable consideration, and there's an element of uncertainty. Okay, so the standard also try to guide users, okay, or practitioners on how to recognize revenue when the revenue to be expected is not fixed. Okay, it depends on certain conditions. We may earn it or we may not earn it. Okay, so in that case, the standard gives us a guidelines on what to do. Okay, if we some revenue recognition is straightforward. You sell goods to a customer, you expect that, oh, it's 1,000 cities. That's what we expect. But there can also be other other terms to the sales. Maybe probably there's a discount factor that, okay, we've sold the goods to you at 1,000 cities. Okay, if you send it home and then maybe you realize that it's not performing as expected, we'll give you maybe a refund, okay, of a certain amount. So that brings in a level of uncertainty of the amount of revenue to recognize, because we may have to refund the customer of a certain amount. Okay, so the standard looks at all these issues. Okay, all these issues. Okay, just a moment. Okay, so let's continue. Okay, so the bottom line is that revenue is recognized when control of goods or services passes to the customer. Okay, so we are looking at control is there's a transfer of control from the supplier to the customer. Okay, so control has taken place. When we say customer has control, it means the customer can direct the use of the product or of the item. Okay, the customer can benefit from the product. That's why we say control has taken place, and that's the point where revenue can be recognized. Okay, so revenue is recognized when control of goods or services passes to the customer. Okay, so when the customer now is in control of it, and not necessarily when cash is received. So it's not about receiving money. Okay, it's more of control than receive of money. Okay. Okay, so when can transfer occur? So into transfer goods or to transfer control to a customer. Okay, it can happen one time. Okay, it can happen one time. So for instance, you sell a product to a customer. So that's one time delivery. Or it can be a series of deliveries, okay, or a series of deliverables. So especially when it comes to construction projects, okay, so If you are undertaking a construction project with many deliverables, you know, with many deliverables, it means that each deliverable is in a way the completion of a deliverable, okay, can constitute a transfer of control to the what's the name, to the customer. So if a construction company is building maybe three apartments, apartment A, B, C. These are separate deliverables. So if this is completed, it means customer has control over this. Customer can use this. Okay, so that's one deliverable. When this is completed, the customer can also start using this in that order. So this is what we call series of deliverables. Okay, so deliverable can be at a point in time, that is one time sale, or over a period of time, which is if it has to do with a construction project. Okay, so let's look at an example. A furniture company delivers a table to a customer. Okay, a furniture company delivers a table to a customer. So here, revenue is recognized when the table is delivered. Okay, as a customer gains control and ownership. All right, so that is it. Okay. Now, there's when we come to, or when we in IFRS 15, there's an important model. Okay, we call the model five-step model. Okay, five-step model used to recognize revenue. Okay, five-step model. Okay, so what are these model? What are these steps? Okay, so these steps is to guide us in recognizing revenue. So the first step is identify a contract with a customer. Identify a contract with a customer. Every transaction involves two parties. There's always a buyer and a seller. So there must be two parties. Okay, we have buyer and seller. So these are the parties to the contract. Okay. So the first one, identify a contract with a customer, and every sale is a contract. Every sale is a what? A contract. Every sale is a contract because it's an agreement between the two people. One is ready to buy, one is ready to sell. So anytime, I mean, there's an agreement between two or more people, that is a contract we are looking at. All right. So every sale is a contract. Okay. So the first one is identify a contract with a customer. Okay. So let's go deeper into the step one and see what we are looking at. So, what is a contract? A contract is an agreement between two or more parties that creates enforceable rights and obligations. So, in a contract, there are two parties. Okay, party A, part, and each party has obligations or right to. Each party has obligations or entitled to certain rights. So for the buyer, he is obliged to make payments. Okay, that's his obligation. And once the buyer makes payment, he has the right to, have access to the product or to use the product. The customer too, sorry, the seller also has an obligation to deliver the goods to the supply to the buyer. Okay, and if once the goods are delivered to the buyer, the supplier has the right to receive the consideration. So each party has rights and obligations. Okay, and it is enforceable. Like it should be enforceable in court. In case of any disagreements, we should be able to enforce it. Okay, and the contract can be written. It can be a formal agreement. It can be oral. Okay, or it can be implied. Okay, so most of most sales transactions are probably oral or implied. So you go to the market to buy some probably cooking materials, cooking ingredients. You buy some tomatoes and onion and from the from the market woman. It's a contract right there, but then it is an implied contract. Okay, you are buying, the woman is also selling to you. Okay, all right. So a customer is the one that has contracted with an entity. All right, so the customer is the one who has entered into an agreement to purchase product or services from the supplier. Okay, so the standard says that a contract can only be accounted for IFRS 15 if it meets the following criteria. Okay, so some contracts are null or they are void. They are void or null contracts. So we are looking at legitimate contracts. Okay, number one, the parties to the contract have approved the contract. Okay, everybody is okay with its contents, with the or is satisfied with the contract. Okay, so in writing, orally, whatever medium they agree upon, and are committed to perform their respective obligations. So each party to the contract is ready to perform their respective obligations to the contract. The entity can identify each party's rights regarding the goods or services to be, to be transferred. So in the contract, each party knows what they have to do. They know their obligations. They know their rights. Everything is in the contract. Okay, then the payment also is stated in the contract. The payment terms is also agreed upon. Okay, and then the contract has a commercial substance. So commercial substance means that it has it's going to benefit the supplier, or I mean it's going to benefit one of them, either the supplier or the buyer. Okay, it's going to benefit either I, either all of them or one of them. But ideally, every transaction should benefit both parties. So yeah, so it should benefit both or one of them. Okay, so there should be a commercial substance. And it is probable that the entity will collect the consideration to which it will be entitled. Okay, so it is the seller should be willing to, what's the name, to receive the consideration to the contract. Okay, the seller should be in the agreement. The seller should um, state how much he or she is going to charge for the product or service. Okay, so it's not like um, a contract with no price. That's usually enough. Usually, those contracts are related party contracts, agreements. So those ones cannot be regarded as a sale transaction where there's no price involved, or the seller is not expecting any form of consideration in return. Okay, that in that case is not. Um, I mean, it doesn't. I mean, IFRS does not recognize such contract as revenue contracts. Okay, let's continue. Let's look. Let's go further into contracts. All right. If both parties can terminate the contract, if both parties, either party can terminate the contract or can just pull out of the contract without one party performing its obligation, then it's not a valid contract. Okay. If one party, so let's say we have entered into a contract to deliver some goods, okay, and one party can just opt out without even starting the delivery. Okay, starting the delivery. It means that it is not a valid contract. That's what the standard is saying. It say a contract does not exist if either party to the contract can terminate a wholly unperformed contract. Okay, a whole, like the contract has not been performed at all without compensating the other party or parties. So if you can just terminate it without maybe paying some compensation to the other party, then it means that it is not a valid contract. In other words, either party can freely terminate the contract without paying penalty to the other party. Okay. Okay, so let's continue. So let's look at an example. A customer pays $10,000 upfront for custom software development. Halfway through the project, the customer cancels the contract and the payment is deemed non-refundable. Okay, now let's look at this. The entity may recognize the 10,000 as revenue since the contract has been terminated. The payment is non-refundable and no further obligation exists. I'm coming. Okay, so this what is the name? This example is on termination of a contract halfway. Okay, so if a contract is terminated in the middle of the contract, okay, then the supplier can recognize revenue for any work that has been done before the was the name, before the termination. So you say where a contract is incomplete under IFRS 15, but the entity received consideration payment from the customer, the entity shall recognize the consideration received as revenue only when either of the following events has occurred. Okay. The entity has no remaining obligation to transfer goods to the customer, and all or substantially all of the consideration promised by the customer has been received by the entity and is non-refundable, or the contract has been terminated and the consideration received from the customer is non-refundable. Okay, so if I mean this is it makes sense. I mean it's rational. So you enter into a contract. I've started doing the work in the middle of the project. Something happened. We have to cancel the project, and the whatever you have paid, I cannot refund. Per the contract is not refundable. Okay, so it means whatever I have received since the inception of the contract, okay, I can recognize it as revenue. Okay. Okay, let's look at another example. Customer B agrees to pay $50,000 for the development of a custom software and software solution to entity A. The software is to be delivered within 12 months. Payments are structured as follows: one, $10,000 upfront upon signing the agreement. Two, the remainder is due upon delivery of the completed software. The software development process is in progress but not complete. After receiving the 10,000 upfront payment, entity A realizes that certain criteria in paragraph 9 of IFRS 15 are not satisfied. 1. The contract has not been fully approved. That is, certain terms remain disputed. So it means like they have not fully agreed to the contract. Then 2, collectability of the remaining 40,000 is uncertain because customer B is experiencing financial difficulties. Okay, so customer A and entity A, they entered into an agreement where customer A will offer a software solution, where entity A will offer a software solution to customer B. And now in the agreement, customer B has to pay upfront of $10,000, and they have to pay the balance of where is the balance? The, he has to pay the balance of 40,000. Okay, at the end of the project. But in the middle of the project, the middle of the projects, some issues came to light. That is, some of the contracts, has not been fully approved. Okay, it means certain terms remain disputed, and now the 40,000 too is not um is not likely to be received because the customer is going through financial difficulties. Okay, so how are we going to account for this transaction? Okay, so let's look at the accounting treatment. So the 10,000 is recognized as a contract liability. Okay, that's deferred revenue. Okay, so on entity A balance sheet until the software is completed and delivered. Okay, so entity A has received the 10,000, but the work is not complete. So they cannot recognize the 10,000 as revenue because the work is not done. So they have to recognize what we call contract liability, okay, which will be in the balance sheet. Okay, it's a liability, which means this means that whatever we have received, okay, it means we have to work for it. It mean we owe the customer that amount of 10,000. Okay, we owe the customer in terms of delivering goods or services to the customer. If we are able to deliver the goods to the customer or render the service to the customer, then we don't have that liability anymore. Then this becomes revenue, like becomes actual revenue. Okay. So the 10,000 is recognized as a contract liability or deferred revenue. Okay. And okay, so until the software is completed and delivered, or it become clear that entity A will not fulfill the obligation and refunds the payment. Okay, so if we complete the job, we can recognize this as revenue. If we are not able to recognize that, if we are not able to do the job, we have to refund the money to the what's the name, to the customer. Okay, So this contract liability account is like a holding. It's a temporal account for holding, I mean, customers' money where we have not, we have not fully performed our part of the bargain or our part of the obligation. Okay, so let's continue. So let's look at revenue recognition. So revenue is recognized only when entity A completes and delivers the software. So if entity A complete the software, we can recognize the revenue. Or if the contract is terminated and the 10,000 becomes non-refundable. So if we terminate the contract and then we are we decide, I mean, per the contract we have to keep the 10,000. Okay, that means the 10,000 that has been paid already is revenue. Okay. So where consideration is received in advance, okay, so customer has paid like deposits, like advance payment, and there's no valid contract yet. Like there's no contract, nothing, no contract yet. Then how do we treat the money we have received? That money we have received should be treated as a liability. Okay, because no contract, we have just received the money. Okay, so that money is a liability. It's like a loan. It's like the customer has given you some money to keep. So it's a loan. Okay, what about if there's a contract? If there's a contract and we have received money from the customer, in that case, we have contract liability. Okay, so we have to know the difference. Here, there's a contract, but we have not performed our obligation. Here, there's a normal liability. There's no contract and we have not also done anything. So it's a liability. Okay, no contract. So therefore it's a liability on us. Okay. So let's look at contract modification. Contract modification. You know, in real world, contracts can be modified. Okay, based on certain conditions. Okay, we can change the terms to the contracts. We can increase the scope of the contracts. Maybe if the contract is to build 10 houses, we can increase it to 15 houses. If the contract is to build 5 rows, we can reduce it to 3 rows. Like that's what we call um, contract modification. Okay. So if the contract is modified, how do we account for its revenue? Okay, that is what we are coming to look at. All right. So let's continue. So a contract modification is a change in the scope or price or both. So we can change the scope of the project either to expand or reduce or the price. Okay. That is approved by the parties to the contract. So all the parties have agreed to the a contract modification can be a separate new contract. Okay, so it can be a new totally new contract. So you have an existing contract. Okay, maybe you're a estate developer and you initially have a contract to build maybe 5 houses. So that's the initial contract. So initial contract, we are building 5 houses. Then later, the client comes back and say that okay, we want to build. Um, so these are residential apartments. Okay, and then say we want to build some hostels. Want to build hostel block, two hostel block for a private university. So this are two separate contracts. Like it's a new contract. Then we have modification of existing contracts. Okay, so there's already an existing contract here, 5 houses, and then the client say, okay, add two more houses to it. So here we are still in the same, I mean, in the same scope. Well, we are in the same, we are doing the same work, all right? But it's only the scope that has changed. Okay, but it's still the same. Let me say projects. Okay, so a contract can be modified. Contract modification can be new separate contracts or um, modification of existing contracts. Okay, so let's look at contract modification as a separate contract. At what point can we say that this contract is a separate contract, is different from the original contract? Okay, so one, increase in the scope of the contracts because of additional promised goods or services that are distinct. Sorry. So the key here is distinct means that are unique, like different from the what we are doing. Okay. So if the scope or if the new contract means we have to do something different from the original agreement, yeah, it means it's a separate contract. Or increase in price of the contract that reflect the entity's standalone selling prices. So if we are the initial contract is okay, supply me with maybe um okay, build 3 houses. Okay, and all for maybe all these three houses going you are the agree the consideration is maybe $300,000. Okay, and later we have modified the contract. Okay, and now meanwhile each house, okay, ideally each house is if you are to build the houses separately, each house will cost like 150,000. Okay, 150,000. So if you add everything together, it is more than the 300,000. But because we are, I mean, building everything together, we have reduced it to 300,000. But if the new contract says that okay, now you are building the 3 houses um for each standalone price, so 150, 150, 150. So that will give you this 300. That's 450. Okay. So now we are building the each house. The consideration for each house is It's stand-alone price, not like a bundle price. Okay, so in that case, we say that the modification is a separate contract, because like we are changing the the consideration of the original contract. Okay, so it becomes a totally separate contract. Okay, so let's continue. So let's look at an example. Okay, where are we? A software company enters into a contract with a customer to provide access to a software platform for 1 year for $12,000. Customer support services for the same year. Both the contract, both the software access and the support services are distinct because the customer can benefit from them independently. So the the platform and the customer service, they are two different contracts. Okay, and the customer can enjoy the software or can use the software without the support. Okay, let's continue. After 6 months, the customer requests additional data analytics services for the remaining 6 months. Okay. B. The company agrees to provide this additional service for 6,000, which reflect the standalone selling price of the service in the market. Okay, so this additional service here, which is 6,000, is a standalone price in the market. Okay, all right. So now let's assess whether this contract, this modification is a separate contract or a modification to an existing um, contract. Okay, one, does the modification increase the scope? Yes, it is increasing the scope because we are adding, some additional services. Yes, it has a new promise service, which is data analytics. Okay. Does the price reflect the standalone selling price? Okay. This new service, is it a standalone price? Like assuming s- the software company is to sell the same service to another party, are they going to sell it at this 6,000? Okay, yes. Okay, the 6,000 charge for the data analytics reflects the company's standalone selling price for this product. So, what does it mean? Because both conditions are met, this modification is treated as a separate contract. Okay, so one, it is increasing the scope, and two, the new service or the new product price is a standalone price. It has no effect on the existing contract. Uh, like, let's say, because there's an existing contract, the supplier may say, "Okay, let me reduce it for you because we have an existing agreement with you. So instead of the 6,000, let me give it to you for maybe 5,000." Or in that case, it is not a separate contract because we are trying to connect, or you are trying to link the new offer to the existing contract. But this is a totally separate offer. All right, so it is a separate contract. Okay, so let's look at modification of an existing contract. Okay, so when a contract modification does not meet the criteria to be treated as a separate contract, it is accounted for as a change to the existing contract. Okay, so um, when there's a modification and it does not meet those criteria above, that the standalone price and then the change in the scope, okay, then it is not. Then it is it's a modification to the existing contract. Okay, so let's look at some examples. Okay, so we have modification as continuation. Okay, modification as continuation. So here we are modifying the contract, but we are just increasing the scope of the work. It's the same work we are doing, but we are just increasing the scope of the work. So let's look at an example. So we have original contract. A construction company agrees to build a bridge for $1 million. Okay, modification. After 50% completion, the customer changes the specification of the bridge, requiring additional work of 200,000. So we are doing the same bridge, but there's a new specification on the project, and that will lead to additional work of 200,000. Okay, so because this is just the same project, okay, nothing has been added. It's the same project, but we are just changing the specification. This is a modification to the existing contract. So it means the the company, the construction company, has to increase the contract amount to 1.2 million. Okay, that's this plus this to give you 1.2 million. This plus this 1. Then let's look at modification as a termination and replacement. So a contract can be modified by terminating the contract, like terminating the contract and replacing it with a different contract. Okay. So let's look at, so it means the old contract, okay, the contract that is terminated, we will recognize any revenue we have earned up to that date, and then we'll start with the new contract. Okay, so let's look at example. A company agrees to deliver 100 units of a product for $10,000. After modification, after delivering 40 units, the customer requests a change. Okay, the customer wants a totally different product. Okay, deliver 60 units of a different product at 120 per unit. So initially we were delivering a certain product. Then the customer says no, deliver another product instead of the original product. So initially we were delivering some, maybe we are delivering product A. Okay, product A. Customer comes back to say stop delivering product A and now start delivering products B. Okay, so we are terminating this contract and we are now um, mounting onto this contract. Okay, so in that case, we have to recognize revenue for the whatever we have done under the existing contracts. Okay, so recognize revenue for the 40 units already delivered under the original terms. Then establish a new contract for the remaining 60 units, which is the new specification by the customer. Okay, So that is these are the issues and the contracts. Um, these are the issues and the contracts with a customer. Okay. Then let's look at numbers two. Identify the performance obligations in the contract. Identify the performance obligations in the contract. Okay. Performance. What are the responsibilities of the parties, of the seller, particularly? Okay. What is the role of the seller? Okay. So, performance obligation refers to the obligation on the entity or supplier to transfer the promised goods or services to the customer. Okay. So, it is on the supplier to deliver the promised goods. Okay. Okay. So the supply can be good, like can be a product, like or a service. Okay. Or it can be a bundle of goods. Okay, we can supply bundle of goods or services. Okay, that is distinct to the supplier. Or it can be a series of distinct goods or services that are substantially the same and that have the same pattern of transfer to the customer. Okay, so here we are saying that, so for instance, if let's say you've won a contract to supply rice or maize to to a secondary school, so every month you supply 10 bags, okay, 10 bags of rice or maize to the school. Okay, so you are supplying what's the name? You are supplying a series of distinct goods. Okay, here is it's a series of distinct goods. Okay, that are substantially the same. Okay, every month you supply the 10 bags. The same item you are supplying. Okay, they are substantially the same. Okay, products that you supply to the customer. Okay, okay. Now let's try and look at when we say distinct goods or service. Distinct. If you say something is distinct, it means it's a standalone product. Okay, it's something that can be enjoyed or it can be used on its own accessories or without any accessories or accoutrements or without that can be used on its own. All right. So um let's look at example. So a company sells a smartphone, okay, with a warranty and an optional subscription for streaming services. Okay, so look at the services here. They sell smartphones, and there's also an optional subscription for streaming, maybe for Netflix streaming or yeah, so for streaming services. Now, are these contract the same or they are distinct? Okay, you say that the smartphone is distinct. Okay, this smartphone is distinct because the customer can use it on its own. The customer can use the smartphone without the streaming service. Okay. The subscription is also distinct because it is separately identifiable and is not dependent on the phone. Okay. The subscription is also, yeah. So it means when we are accounting for revenue, We have to account for the revenue for the smartphone and also for the subscription. We cannot combine the two because they are separate what's the name supplies. Okay. So let's look at an example. A construction company agrees to design and build a custom building. Okay. The design and construction are not distinct because they are interdependent and integrated into the delivery of a single output, the completed building. If the good or service is distinct, it is treated as separate performance obligation. Okay. So in this example, the construction company, the contract is for the construction company to design and to build. Okay. These are two, I mean, they look like um two obligations, or yeah, two performance, designing and building. But they go together. You have to design and build. So we cannot say that the design is a separate obligation and the building is a separate obligation, because this building depends on the design. Okay, the building depends on whatever we design here. So therefore, the two are not separate obligations. So we cannot invoice for the design and invoice for the building. Everything must be one, like one contract. Okay, that's what we are talking about. Okay, now let's look at a series of distinct goods or services with the same pattern of transfer. A series of distinct goods or services with the same. So if the contract involve repeated deliveries of goods or services, okay, that are substantially the same, okay, the identical service or units of good and delivered in the same pattern. So, like the example I gave, you have won a contract to deliver food items to a secondary school. Every month, you deliver um, those products, these food items to the school. Okay. In such cases, the contract is treated as one, like it's a single contract, but it's just that you are breaking it into series of deliverables. Okay, so in such a case, the whole contract is one contract, all right, but just that we are delivering it over a period of time. So let's look at an example. A cleaning company provides daily cleaning services for 1 year. Okay, so every year, okay, yeah, daily cleaning service. Every day they clean their client's office. Okay, each cleaning session is distinct because the customer benefit from each one independently. So every day, whatever cleaning that takes place is for the day and it's distinct. It's unique for that day. Okay, but however, since the sessions are substantially the same and provided on the same pattern daily over a year, okay, they are treated as one series performance obligation. So if every day we go and clean the place, even though each day can be seen as a separate work or obligation, but um, if you look at it, it's one obligation, it's one contract. Okay, that we have to satisfy. Okay, so we have looked at performance obligation. Okay, the next one is determine the transaction price. Determine the transaction price. So, where is the transaction price? Okay, the transaction price. The transaction price is the consideration in the contracts. Okay, what the supplier is charging for the obligation for their obligation in the contract. Okay, so the transaction price is the amount of consideration to which an entity expects to be entitled. Okay, the word is expect to be entitled. Okay, what they are expecting to, earn for what transferring the promised goods or services to the customer. So what are we expecting for the work we have done to the customer? Okay, that's the transaction price. But it excludes amount collected on behalf of third parties. Okay, the transaction price does not include amounts collected for third party. Example is sales taxes. So when you sell goods and there's VAT on it, that VAT is not for you, is for GRA. Maybe the cost of the price is 1,000, the VAT is 100, so you are charging 100. But this one is for somebody. So therefore, this any amount that is collected for third parties is not part of the transaction. It does not is not part of the transaction price for the supplier. Okay, now when it comes to transaction price, there are certain factors that come into play. Okay, one of them is variable consideration. Okay, variable, like where the consideration may change, even though we have agreed that we are charging maybe 1,000 cedis, but the things can change. Maybe discounts may come in, or maybe refund. Certain things may happen where the amounts may not we will not get the same amount that we I mean we quoted. So these are the issues: rebates, refunds, discounts, performance bonuses. Okay, these things can affect how much we are supposed to receive. Okay, so these are called variable consideration. Like they can affect how much we expect to receive. Okay, so let's look at an example. A construction company enters into a contract to build 50 identical houses for a housing development. The terms include: A, base contract price of 500,000. Okay, so we are initially paying 500,000 for the work. Then two, bonus performance. Okay, the company will earn a bonus of 50,000 per house if the house is completed by the agreed deadline. So this 50,000 is a variable consideration. They will only get it if they meet the deadline. You see, so the variable consideration. The bonus depends on timely completion of the work, which can vary due to factors like the weather, you know, labor availability, supply chain delays. So this 50,000 can be a variable consideration. So when you determine the transaction price, you have to also look at it. Okay, now, so if there's a variable consideration, we try to find the weighted average. What on average are we likely to earn that variable consideration? Okay, so let's look at how we can determine the average consideration. Okay, let's look continue. The company has a large number of similar contracts in its portfolio and knows from experience that 70% of houses are completed on time. So, per their experience, they know that 70% of the contracts of their houses are completed on time. So, it means if that's the case, then they can get that 50,000 bonus. So there's a 70% chance that they can get the 50,000 bonus. Then 30% of the houses are delayed. So there's no bonus if there's a delay. Okay. So the company has to do some weighted average. The company uses expected value method to estimate the bonus it expects to earn for each house. Okay, so they are expecting bonus of 50,000. There's 70% chance of earning the 70,000 of earning the bonus. So 70% times 50,000 will be 35,000. Okay, so they try to find the average. Okay, which is the base price of the 500,000. Okay, which is here the 500,000 here, and then the weighted or the expected value of the bonus, which is the 35,000. So this plus this will give you 535,000. Okay, so this becomes the consideration. Okay. So there's a constraint. So looking at how let me say what's the okay, let me say okay, looking at the volatility or let me say volatility of variable consideration. It can change. You may earn it, you may not earn it, you know. So the standard says that before you include variable consideration, okay, there should be a high probability, okay, that whatever you have included will not be reversed. Okay. So before you include a variable consideration, there should be a high probability that we are not going to reverse what you have recognized. Okay, so the 35,000 that we have included, there should be a high chance that we'll earn it. Okay, and the chances of earning this 35 is 70%. So there's a high probability that we are going to earn the 35,000. Yeah, this is just an average, so we can earn more than that, which is the 50,000. So let's look at an example of a situation where we don't stand to earn the variable consideration at all. Okay, so let's look at this. A construction company enters into a contract to build a bridge for 1 million. It can earn 200,000 bonus if the project is completed within 12 months. Okay. However, the project is complex with potential delays due to weather and regulatory approvals. The company has limited experience with similar projects. So you see, the project is complex, they don't have much experience. So should they recognize this 200,000? So that's what we have to look at. So analysis. the uncertainty is high. The uncertainty is what is high, and external factors such as weather are beyond the company's control. Yeah. And given the uncertainty, it is not highly probable that the bonus will be earned without significant reversal. So if the company even decides to recognize the bonus at the start of the project, it's very likely they will have to reverse it because they will not meet the criteria. Okay. So what should the company do? The company should exclude the 200,000 bonus from the transaction price. Okay. They should not even think of it. They should not think of this bonus because it's it's beyond their reach. I mean, at the beginning of the project, until the uncertainty is resolved or significantly reduced. So if, I mean, as time goes on, they feel based on I mean their schedule, they can earn the 200,000, they can bring it in. But until that, they should not think of the 200,000. Okay. Now let's look at another issue under consideration. Okay, the issue of financing. Okay, the existence of a significant financing component in a contract. Okay, financing is what's the name? Giving out loan. Okay, providing a loan for a period of time, and we know loans attract interest. So if a contract is such that, I mean, it's potentially a loan, okay, in a for a period of time, then we need to look at the interest component on it. So let's look at indication of significant finance component. Okay, advance payments. Okay, customers pay significantly in advance. Okay, so you contract a customer to undertake a project. The customer has paid you immediately. Meanwhile, the project will start in the next 2 years. The project will start in but the customer has paid you right now. So and now you have the money. So in other words, it's a loan the customer is giving you for a period of time until you 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 start the project. Okay. So if the customer has given you a loan, money in advance, then you have to account for the interest. Okay, you have to account for interest expense. Okay, you have to pay interest on the money the customer has given you. Okay, that's one scenario. Then we have advance payment. We also have deferred payment. So I deliver goods to a customer, and the customer has 3 months to pay. Sorry, not 3 years to pay. I mean, 3 months is short. So 3 years. So this is also a form of loan. Okay, because I've given them the goods to the customer. The customer has 3 years to pay. Okay, so which is also a form of loan. So the customer has to, I have to, the customer has to pay me interest. Okay, for the delay in paying in paying for the product. Okay. Okay. Now let's look at non-cash consideration. All right. So the payments can also be in a form of other consideration other than cash. So like a barter trade or exchange agreement. Okay. So if the agreement does not involve money, or yeah, it's not in monetary terms, then whatever is exchanged should be at the fair value. Okay, that's what the standard say. In a non-cash consideration, The value of the item that is being exchanged or is being used as a consideration should be at the fair value. Okay. If an entity cannot reasonably estimate the fair value of the non-cash consideration, okay, the entity shall measure the consideration indirectly by reference to the standalone selling prices of the goods or services promised to the customer or class of customer in exchange for the consideration. So if the fair value of that non-cash item cannot be used, then the seller or the entity should use the selling price of the product as the consideration. Okay, that's what the standard is saying. So let's look at consideration payable to a customer. Okay, consideration payable to a customer. So it's not always the supplier who receives the consideration. Sometimes the supplier also has to pay something back to the customer. Okay, so in the form, so these are the various ways: in the form of cash rebates or discounts, or in the form of volume-based incentives. Okay, so when the customer buys in large quantities, the supplier can give the customer some incentive. Okay, or free goods or services. So the supplier can give some free goods or services in return, maybe for something that the customer has bought, purchased. Okay, so like we have buy one get one free. So you buy one item, you get. Okay, so that's also a consideration that is given to the what's the name to the customer. All right. So let's continue. So how do we treat consideration that is given to a customer? Okay, how do we treat consideration given to a customer? Okay, the consideration given to a customer, we should is subtracted. Okay, is subtracted from the transaction price. Okay, like a discount. We take discount from the gross amount or the transaction price. Okay, so we have talked about uh, the transaction price. Okay, we have talked about the transaction price. So let's look at allocate the transaction price to the performance obligations in the contract. Okay, so after the transaction price, we need to allocate the transaction price to the performance obligation. Okay, so in the contract, if there's we need to deliver 10 bags, okay, for 3 months. Okay, and the sum of the contract is maybe 3,000 cedis. Okay, for these three. So we need to allocate this 3,000 over each of the performance obligations. So maybe this one may be 1,000, this one may be 1,000, this one may be 1,000. So when we add, we get it. So it means that when we deliver this product, we can recognize revenue of 1,000. When we deliver this product, another 1,000. Okay, so that's what we mean by allocating the transaction price to the performance obligation. Okay, so that's what it means. Okay. So sometimes the product, okay, sometimes what's the name? Especially when it has to do with bundle products, like group of products that are delivered together as a bundle. Okay, sometimes those agreements are subsidized. Okay, because it's a bundle product, so we try to reduce the the amount. So assuming that so each contract is each bag is 1,000 cedis. But assuming that we are selling only this bag, like if it is only this standalone bag we are delivering, maybe it will be 1,200. Okay, but because it is part of this, it's part of a contract. Okay, we have reduced the amount to 1,000 cedis each. Okay, so it means there's a discount on these deliveries. So in that case, we need to account for the discounts. Okay, we need to be able to determine the discounts that we have allocated to each of the per- each of the what's in the prices for each performance obligation. So let's look at an example of a situation like that where we have a bundle of products we are selling, but because it's in bundle, we have reduced the price. But if we are to sell them alone, okay, the price would have been more. Okay, so let's look at example. A company enters into a contract to sell four distinct products to a customer. Okay. The promise to transfer each of these products is a separate performance obligation, and the agreed contract price is 14,400. Okay, so they agreed that everything will be 14,400. Stand-alone selling prices are as follows. If they are to sell the product individually, okay, product A is 4,800, product B 7,500, product C 2,700, product D 3,700. Okay, so required, calculate how much contract price or how much um, transaction price to be allocated to each product. Okay, so how do we go about it? When we add all the four, this one, two, three, it's more than the 14,400. So let's see how to go about it. So we have product A, product B, product C, product D. Okay. So product A, B, C, D. So product 4,800, 7,500, and then 2,700, 3,000. So the when we add all of them together, we are getting 18,000. Assuming we sell them individually, we're gonna get 18,000. But because it's a bundle, we are getting how much? 14,400. Because the bundle, we are selling it for 14,400. So what should be the selling prices, or how much revenue should we account for each of the products? Okay, so we need to find the discounts. So this minus this is a discount. There's a discount of 3,600. Okay, so this discount must be shared among this. Okay, so there's a standalone price. So we have the discounts. So we have the new price. So we are going to share the discount. So the first one, so it will be the it just was it's going to be on pro rata basis. We are going to allocate the discount based on the relative weights of each product in the total amount. Okay, so when we take the product A, okay, the discount is going to be the product over the total minus, then we multiply it by the 3,600. Okay, so that will do for all the rest. So this will be 960. So so when we add the discount, we should get 3,600. So what will be the new price? So this minus this, give us this. You see like that. So yeah. So this is going to be the new price. Or this is how much revenue we recognize for product A, product B, product C, product D. Okay, so that is how it is. So in exams, if you are given a question like this, that's how we go about it. Okay, so so let's look at um let's look at some camera. Let's okay major project was okay. Let's look at the last step, which is which is which is recognize which is recognize revenue when or as the entity satisfies a performance obligation. Okay, so the last step is the revenue recognition. Okay. So after we have allocated the transaction prices to each performance obligation, so we know that okay, if we perform obligation A, we will get this. If we do obligation B, we'll get that. But we should only recognize revenue when we have actually performed those obligations. So that is the last step. Okay, on the recognition of revenue. Okay. So that's satisfaction of performance obligation. So satisfaction of performance obligation occurs when the entity supplies, supplies the promised good. Just a moment. Okay, let's continue. All right. So satisfaction of performance obligation occurs when the entity supplies the promised goods or services to the customer. Okay. So there are two ways of satisfying a performance obligation. Okay. So performance obligation can be satisfied in two ways. The first one is one-time satisfaction. Okay, like when you deliver the product. Okay, like maybe online. You run an online delivery service. Once you deliver the product to the customer who has ordered it, that's it. Or performance obligations satisfied over time. So this is where the project or the obligation is for an extended period. So we have to perform the obligation over a period of time. Okay. So for performance obligation satisfied at a point in time, like the one time performance, is very straightforward. Once we deliver the product or render the service, we recognize revenue. But performance obligation satisfied over time, we have to break the revenue recognition down, so that anytime we deliver the product, then we recognize revenue. Okay, that's what it means. Okay. So let's look at characteristics of performance obligations satisfied over time. One, the customer simultaneously receives and consumes the benefit provided by the entity performance as the entity performs. Example, in a cleaning service contract, the entity provides cleaning service daily and the service is consumed by the customer at the same time. Okay, so that is an example of performance obligation over time. So as the service is rendered, then the customer or the client is benefiting from it. Okay, so that is one characteristic. Okay, number two, the entity's performance creates or enhances an asset. So as the entity is doing or gradually satisfying the obligation or performing the obligation, they are also creating assets for the the customer or clients. Okay, so for example, work in progress. So if a real estate developer, you have been contracted to build maybe a story building, maybe 5 story buildings. Anytime anytime you complete a story, it's a work in progress. It's an asset to the client. It's not your asset. It's not for you. Because you are building it for somebody. So anytime you complete a part of it, it's like you are creating an asset, or you are enhancing an asset to your clients or to your customer. Okay. So let's look at an example. A construction company builds a factory on a customer's land. Okay. The factory is an asset under the customer control as it's being constructed. Okay. So as the construction is going on, the customer is also getting the assets. Okay. Revenue is recognized progressively as the construction work is completed. So as we are doing the work, then we are also recognizing revenue. Okay, from the perspective of the supplier. Okay, as for the supplier, they are recognizing revenue. For the customer, they are recognizing assets. Okay, because they have the work in progress. Okay. So how do we recognize revenue over a period of time? Okay, how do we do that? Okay, so there are two ways of going about it. We have output method and the input method. So the output method, it looks at what we have been able to do as compared to the total obligation um, we have to complete. So if let's say the work is 100%, okay, and we have done 20%, it means we can recognize revenue of 20%. So 100% of the whole project is maybe $10,000. Okay. And we have done 20%. So how much revenue? The revenue we can recognize is 20% of the 10,000. Okay. So if we do 30%, then 30% in that order until we complete the project. That's the output method. So here we we recognize revenue based on what we have done. Okay, based on what has been achieved. Okay, so let's look at example. A construction company is building a bridge for a customer. The total contract price is $10 million, and the project is expected to be completed in 2 years. The construction company determines that the transfer of control is continuous, and revenue should be recognized over time using the output method. At the end of year one, it will determine that 40% of the bridge is completed. So 40% of the bridge is completed. Okay. Revenue recognition. Based on the output method, the company recognizes 40% of the total contract price as revenue for the first year. So for the first year, revenue is 40% times 10 million, 4 million. So uh, what would be the journal entry? We will credit revenue, okay, of 4 million. Then we will debit um will debit was the name contract asset or account receivable of 4 million. Yeah. Then we have the input method. Okay. So the input method, it looks at how much we have. So the input method looks at the resource utilization for the project. So if we are to use maybe the project will cost us the total resource we need for the project is maybe 5,000. We need 5,000 to complete the project. Okay, that's the resource allocated to the project. And we have used 2,000 out of the 5,000 resource we have. Okay. So the completion, okay, for the 2,000 will be the 2,000 over 5,000 multiplied by the contract price. So if the contract price is maybe 8,000, then you multiply it by the contract price. Okay. So that's the input method. So the input method looks at the resources we are using or we have used in the project. Okay. Okay. Let's look at conditions to recognize revenue equal to the cost of the good used to satisfy the performance obligation. So this is a different case where, let's say you have been contracted to um what is the name, maybe to install what is the name, electricity, what is it, a power plant for a company. Okay, you have been contracted to install a power plant for a company, and you have gone to buy the power plant with your own money. Okay, you have purchased a power plant for maybe $200,000. Okay, it's your own money you used. Okay, but this $200,000, okay, it's part of how much you are charging. So it's inside the contract price. Maybe the contract price is maybe 500,000. Okay, so but you have used 200,000 already to purchase the plants. Okay, so the standard says that in situation like this, you can recognize revenue for what you have. I mean, what you have incurred. Okay, what you have incurred so far on the project. Okay, so this is to recognize revenue equal to the cost of the good used to satisfy the performance. But there are some conditions that must be met before you can go by this method. So number one, the good is not distinct. Okay, so the whatever we purchase, like this power plant, okay, it's part of the project. It's not distinct. It's part of a project we are undertaking. It's not like a different project altogether. It's the same project we are doing. Okay, so the transfer good is part of a larger performance obligation and cannot be considered a standalone deliverable. Okay, for example, delivering a specialized machine that will later be integrated into a broader system. Okay. Then number two, the customer is expected to obtain control of the goods significantly before receiving the services related to the good. So after delivering the power plant, the customer can start using the goods even before other installation and other things are done. Okay, so explanation. The customer gains control of the goods significantly before the related service, maybe installation, customization are completed. So this means the customer has the ability to use or direct the good before the entire contract is fulfilled. All right. Number three, the cost of the transfer good is significant relative to the total expected cost to completely satisfy the performance obligation. If the item we purchase is it's costly, or it's um what's the name? It has a high cost as compared to the total cost of the project. Okay, then we can go by this method. Okay, Then number three, the entity procured the good from a third party and is not significantly involved in designing and manufacturing the goods. So the contractor purchased the that machine. They don't manufacture that machine. They also buy from somewhere. Okay, they purchase it somewhere and then they are installing for the customer. Okay, so let's look at an example. Suppose a construction company procures a custom built HVAC system from a third party and delivers it to the customer early in the contract. While the HVAC system is essential to fulfilling the contract, the company is not heavily involved in its design or manufacturing. The company then provides additional services like installation and integration over the next few months. So in this case, the HVAC system cost is significant compared to the total project. The customer gains control over the system upon delivery. Okay, so to faithfully depict performance, the company may initially recognize revenue equal to the cost of the HVAC system upon delivery. The remaining revenue will be recognized as the additional services are provided. Okay, so this is the case of recognizing revenue equal to the cost of the goods used to satisfy the performance obligation. Okay, so we'll end here and tomorrow we'll finish the standard. So there are a few things to, there are just some few things left to finish the standard. All right. Okay, so we'll end here and we'll continue tomorrow.
Okay, thank you very much.
Okay, you're welcome.